We've never done this on a global scale before. We're all making Weimar Germany kinds of mistakes around the world, and there's no one left to fix it for us.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And back with us today is John Rubino from dollarcollapse.com. John, thank you so much for joining us today.
Hey Elijah, good to talk to you again.
Great to speak with you as well. And what I'd first like to discuss is the concerns over inflation. It doesn't seem like the Fed is that concerned about it. There was just an article in the Wall Street Journal about this, how, the Fed is not really concerned about it, but that should maybe concern investors. And the way that the Fed is acting is very dovish, right? And they have this perspective that, we can kind of let inflation go above 2% and then we can control it later. What is your perspective?
I wonder about this concept of temporary inflation. That's a fairly new thing in Fed speak lately. To understand what a mess this is, we kind of have to take a couple steps back to two things, really. One is that over the previous couple of decades, the Fed has been changing how it calculates inflation. And it's been basically not counting things like stocks, bonds, and real estate as part of the cost of living, even though if you're an investor and you're trying to save for the future, the cost of investing, which is the cost of stocks and bonds, is a part of your cost of living, right? So we should be counting those things. And if we did count them, we'd already be in a very inflationary environment. We'd have a CPI of 3 or 4% now, which is way above the Fed's target, way above normal functioning for the financial markets. So we'd already be there. And in reality, we already are. We're just not counting it that way. The other thing is that long stretches of artificially low interest rates, which is what we've had for the last 20 or 30 years, does something to a market. It first of all causes people to borrow money, because that's the point of low interest rates. And they borrow that money and they spend it, and they cause economic growth to happen that way. So it creates what seems like a normal world, but it also structurally changes the financial markets, because it leads to a larger and larger number of people who have variable rate debt or have short-term debt that has to be rolled over, who just can't tolerate higher interest rates. So long stretches of low interest rates make a system more and more vulnerable to rising interest rates. So here we are. We've already got inflation in reality, but we've got the Fed saying, according to our official measures, there's no inflation. So don't worry if it ticks up a little bit in the next year, we'll reverse it back out later. And we've got extremely low interest rates, but that are rising as the markets start anticipating inflation. Because, if you're buying a bond, which is to say, if you're lending money to someone, you want a return that exceeds the rate of inflation. So as your perception of inflation goes up, you want higher interest rates on the stuff you're lending out. So that's happening. So we've got rising interest rates, and in a society that can't tolerate rising interest rates, and we've got rising inflation, which is a cause of rising interest rates. And you got the Fed stuck in the middle somewhere, because if interest rates were to go up, normally the Fed would counter that with easier money to push interest rates back down, because we can't have rising interest rates. But if inflation is rising, and that's what causing interest rates to go up, normally the Fed would counter rising inflation with higher interest rates. So they're stuck in a place, or they will soon be stuck in a place, where fixing one of their big problems exacerbates the other big problem. And then the question becomes, when does everybody figure out that these guys are absolutely clueless? They do not have a fix for the total range of problems that we're looking at right now. And then how do the markets react to the realization that the Fed is basically over as our adult supervision? They're not daddy anymore who steps in and saves us every time we screw up. because they themselves have screwed up and they've lost the ability to fix the problems that are caused by their previous mistakes. Okay, so that's where we are, which makes the coming year of bailing everybody out in sight and creating huge numbers into dollars and just dumping them into the market an extremely dangerous thing to do, and yet we're going to do it. So I think we're reaching what could be one of the big turning points in the fractional reserve banking, fiat currency world. And no one seems to get that yet. The federal government is blithely just creating stimulus plan after stimulus plan. The Fed is just happily going along and financing the whole thing and telling everybody not to worry about inflation. But I think things could easily get much, much more serious in the not too distant future. And the way we'll know is what's happening with the 10-year Treasury yield, because that's the interest rate that everything else keys off of. So watch that rate. If it goes up above a 2 handle, right now it's about a 1.7%. But if it gets up into the 2s, then all of this stuff I just talked about start to become a reality, and the world gets a lot more interesting and scary.
If you kind of look out into the future, like what are some of the scenarios we could see? Would it be like high inflation, then rising interest rates? Like, could you share with our viewers like what you see maybe in the next year or two?
Yeah, well, let's take a specific scenario and say that commodities continue to go up, because previously we just had stocks, bonds, and real estate going up. That was it. They aren't part of the CPI. So it wasn't really inflation, according to the government. But now you've got food prices going up, fuels in some cases going up, lumber and other building materials getting more expensive. A microchip shortage around the world, which is making appliances more expensive. I know that because we're building a house, and all of a sudden, the refrigerator that my wife wants is just out of stock. It can't be found anywhere because there are no microchips to make those things anymore, which leads to higher prices. So, metals like nickel, cobalt, copper, iron ore, those things are all way up. So you've got broadening inflation. So let's say that continues. And that bumps up the CPI to 2.5, 3.5%, somewhere around there. That causes interest rates to go up, and that starts bankrupting people everywhere you look. And not just individual people, but governments, corporations, everybody who's got an exposure to higher interest rates sees their interest costs go up, sees their financials become more and more dicey, and some of them fail, causes others to fail, and so on. So we head into a scenario like that, where higher interest rates start to cause a cascade failure of the over-leveraged part of the world, which is to say most of the world. And then the system just, it has to deal with that somehow, but it's not clear how we do that. So that's going to be a really interesting turning point in our perception of the guys in charge, because, they were always screwing up, but we didn't realize they were. Now, when we realize that they made a mess of things, then the financial markets become a very different place. And so we'll have to see what happens. I don't know what will happen from there on out, because we've never done this on a global scale before. Individual countries have made mistakes like this and suffered for it. But in the context of a sound money world, where everybody else was on the gold standard, so what if Germany has a hyperinflation? The rest of us are basically okay, that kind of thing. Now, we're all making Weimar Germany kinds of mistakes around the world, and there's no one left to fix it for us. And one player that will get a lot of headlines in all of this is the IMF, because some people think that they will become the central bank to central banks and bail out all the really big financial entities in the world. But I don't know. I don't know that they have their currency, the special drawing right, is just created from a basket of the other crappy currencies in the world. So it's not clear that that's a true fix. So we'll just have to find out. But look for the IMF to become headline worthy in the next 6 months when all of this starts playing out.
So when it comes to really what is going to happen in the near future, the next 6 months, You mentioned how this hasn't ever happened on a global scale before. And you also mentioned Weimar Germany, right? And that might be like, wait a second, are you calling for hyperinflation? So the question is, I guess, some people they might see inflation coming really soon, but the idea of like hyperinflation in the United States seems kind of far-fetched. What is your perspective on that?
Well, yeah, hyperinflation takes a lot of mistakes to create. But the question is, will we make those mistakes when interest rates start going up? So let's say interest rates start going up, lots of people start going bankrupt, and the Fed responds to that, excuse me, with easier money. In other words, they come in and start buying 10-year Treasury bonds with newly created currency in order to force interest rates down because that's their immediate problem. Well, what does that do? That turbocharges the inflationary part of the economy because already inflation was rising, and that's what made interest rates go up. So if we focus solely on pushing down interest rates, and that makes inflation go up even more, you reach a point where it runs out of control. And that's what I'm talking about. Weimar Germany was fairly specific in that they owed the rest of the world insane amounts of money after World War I when they couldn't pay, so they just printed the currency in order to pay it. That might take us a while to get to that point, but we're making mistakes of the same quality. In other words, we're ignoring the effects of too much currency in the system in order to be able to continue to flood the system with new currency. So it may not end with a Weimar Germany style hyperinflation, but if it doesn't, it'll be because interest rates spike and get away from the central banks and crash the system and send us back into a 1930s style deflationary depression. But we really only have those two choices. There's no, actually there's a monetary reset, which is a huge burst of inflation followed by stability. And that's the low probability, but least painful way of getting out from under this. But more than likely, based on the attitudes and the past behaviors of the guys in charge, we're going to run this inflation thing out until it can't be run out any further. And at that point, we'll probably have some kind of a spiking interest rate driven crash. But, there's a period of rising inflation before that that is, I don't know, I don't want to say unavoidable because that's too definite, but really hard to avoid, I think is completely valid. Because we really are. I mean, in the U.S., but not just in the U.S., we're not done with the whole stimulus thing. The Biden administration here is talking about another stimulus plan like the one that they just implemented last week, followed by a big infrastructure building plan, which might be $4 trillion. And if that doesn't work, they'll keep on doing this stuff. So, we're behaving as if inflation is either non-existent or very easily managed when it's neither of those things. So I think the magnitude of the mistake that they're making and the problems that could flow from that are just immense. As I said before, unprecedented. The human race has never done this before, and the resulting problems will be commensurately extreme and unprecedented and hard to handle.
You mentioned unprecedented, and I feel like that might seem like an overused term nowadays, but I mean, with respect to the stimulus, it is unprecedented, right? The COVID stimulus was the biggest stimulus package ever in America's history. So we see all these things that haven't been done before. And you mentioned how really this bailing out of everybody, you've mentioned this on a different program, but this idea of bailing out everybody, which is kind of the situation right now, was inevitable even before the pandemic. It wasn't the pandemic kind of made everything speed up in a sense, but why do you think that really this bailing out everybody was inevitable anyways?
Well, once we went off the last vestiges of the gold standard in 1971, we basically handed an unlimited credit card to all the world's governments, and they, of course, abused that privilege. The central banks then were obligated to push interest rates down to lower and lower levels in order to manage all the excessive debt that governments were creating and causing to be created, so that we had a series of booms and busts. Each one was bigger than the last, and the level of interest rates to get us out of the bust was lower than last time around, until we were at 0 to slightly negative in a lot of big interest rates around the world, which means that the next bust or the one after that, in other words, a bust was coming as the amplitude of the busts get bigger and bigger. That was going to be so immense that the governments of the world would basically have to bail out not just the bubble sector, not just tech stocks or junk bonds or housing, but 5 or 6 comparably large sectors around the world. And, we're there now. We didn't know when it was coming before, but the pandemic lockdown caused such a steep recession in the US and around the world, and, virtually bankrupted so many different sectors of the global economy that we're there. This is the bust in which we have to bail out everybody in sight. Okay, so, in the US, you've got student loans, $1.5 trillion, 2/3 of that at least is going to have to be wiped out by the government. You've got state and local governments who had let their pension plans run out of control. Their public sector pensions were going to bankrupt them even in good times. But now it's much, much worse. Their public sector pensions, police, teachers, firefighters, those pension plans are so underfunded that a lot of cities and states are just flat out bankrupt unless the federal government steps in and bails them out. They're going to do that. That's on the list of things to do for the Biden administration. And it just goes on and on. The number of entities and sectors that need to be bailed out is just immense. And you can't let any of them fail. You have to bail them all out, because if one of them fails, then they owe money to several of the others who then fail, and on and on. It just goes on and on. You can start a cascade failure of the whole system by letting one over-leveraged sector fail now. So they have no choice. So that's what we're going to see in the next few years: is trillions and trillions of new dollars created and sent to specific sectors in order to paper over their past mismanagement. So yeah, this is the thing that was always seen as kind of the end game in the fiat currency system, because, doing that may work. It may paper over a lot of those problems, but all of that currency that's out there shifts the pressure from the real economy to the financial economy, specifically currencies. In other words, it causes prices to start to rise, which is the same way as saying the value of the currencies are going down. And once that becomes, what word do I want here? Anyhow, non-stable. If it goes non-linear from there, then that's what blows up the financial system and leads to the monetary reset or the hyperinflation or the deflationary depression. That's when we have these final choices and we have to pick one. So the pandemic moved that eventuality into the present. We are now doing that thing. We're bailing out everybody in sight, and the consequences will be felt in the short rather than the long term. So yeah, in the next few years, we're going to have to make these decisions, and we're going to have to deal with the consequences of them. And it's going to be brutal for most people, I would think, and I think that kind of takes us into the precious metal story here, because you want to be out of the financial assets that are going to be hurt most by this process, and in things that either are immune to rising inflation and other kinds of monetary chaos, or actually benefit from them. And historically, that's been farmland, which, by the way, not Jeff Bezos, but Bill Gates is now the biggest farmland owner in the United States. He sees this coming. And gold and silver, which have been traditionally the forms of money that governments can't create more of, and therefore they tend to hold their value when crappy national currencies are inflated away. And a few other things. You want to be over there and not in the financial economy when this hits.
And you mentioned precious metals, and gold is one of them that definitely is good during inflation. You also mentioned how there is going to be this interest rate spike potentially, and we're kind of seeing a rise on the 10-year Treasury yield, which people argue is what is pushing gold down. And historically, there's been very, very strong negative correlation between the 10-year Treasury and gold. So if we're going to see this rise in interest rates, then why are you bullish on gold?
Well, it's not just interest rates, it's real interest rates. In other words, the inflation adjusted interest rate. So if if the 10-year Treasury is yielding 2.5%, and inflation is just 1%, then that's a high real interest rate, which is bad for gold and silver. But if inflation goes up to 4%, then you've got a negative interest rate of 1.5%, and that's great for precious metals. So it's kind of a race between interest rates and inflation. And for the government to step in and try to cap long-term interest rates while they're taking steps to increase the inflation rate, what that means basically is that they're creating a more and more negative interest rate. And that's a good environment for gold. So yeah, it could be that there's some backing and filling that goes on while this plays out. If, say, the 10-year yield spikes and people perceive that as a positive real interest rate that's rising, you might see things like gold get hit in that process. But the longer term process that's playing out here is inflation getting ahead of interest rates, because governments will have to try to suppress interest rates. And that'll be really good for precious metals. So yeah, it's not a 6-month in and out trade with gold and silver. It's insurance against the really seriously bad thing that's going to happen to the financial markets if current policies stay in place. So you don't want to jump in at today's prices with both feet. You want to dollar cost average. Buy a little bit each month, starting right now, and hope that this thing goes on for another few years to allow you to build up a big enough position to be totally protected from the really serious consequences of this. Or go back in time 5 years and start stacking then. The guys who've been stacking all along are in perfect shape for this, because it doesn't matter to them if gold drops by 10% or silver drops by 20% from here, because they know that at some point in the future, gold and silver will become much more valuable. But yeah, you can't predict what's going to happen in the short run. And another thing that's a big risk for precious metals is a stock market crash, because what happens when equities drop, and they could be pushed down by rising interest rates as well. But when people start losing a lot of money, especially in their leveraged equity positions, in other words, if you've got margin debt, if you borrowed money against your stocks to buy more stocks, and you're facing a margin call where your stocks are down so far that your brokerage house is going to liquidate your position unless you come up with more cash, well, you look around for things that aren't down yet, and frequently that's precious metals. So then you sell that by necessity. That pushes them down, and then basically everything is down. And that's happened the last few times stocks have fallen in a taper tantrum kind of market where they just crash, and then the government steps in and bails them out, and they go back up. But precious metals went along with stocks, which makes them risky in the short run. But again, if you're dollar cost averaging and there's a temporary, V-shaped drop in precious metals, that just means you buy more ounces while that's happening. And then you ride those ounces back up when the government steps in to bail out everybody like it will. So yeah, nothing is risk-free in the short run, but things like precious metals that tend to do well in rising inflation, negative interest rate environments will tend to do better and to hold their value over a long period of time. So that's it's where you want to be, even though they're not risk-free, because the other things, stocks, bonds, real estate, bank accounts, those things have become extremely risky now. And they're really unacceptably risky at this point, given what the governments of the world are doing.
You mentioned how, really to have a long-term view when it comes to physical precious metals. And I think that's a really good point. On, I guess, more of a speculative side, or more of a side of more than just having insurance, one way that people can invest in the precious metal sector is through mining stocks as well. And we were talking before the interview how you see possibly a really good opportunity right now for the mining sector.
Well, yeah, the gold miners are, I wouldn't say they're alone, but they're in the tiny minority of companies that actually have good fundamentals right now, because gold and silver at their current prices, they've been languishing gold in this, the 1700s or so for a long time, it seems. And that's kind of disappointing to gold buyers and, the people who have made big bets on precious metals in the past. But it's actually not bad for miners because that's a level at which the thing they're selling, the underlying metal, generates a lot of free cash flow for them. So yeah, gold is just kind of sitting there. The miners' prices may also be sitting there because of that, but their balance sheets are improving because they're generating free cash flow, they're paying off their debts, or they're increasing their exploration so they can mine more ounces going forward. So they're becoming better companies while they're just sitting there and while gold and silver are just sitting there. And at some point, all this free cash flow is going to start burning a hole in the pockets of the executives of the major gold and silver miners. And they're going to do what they always do in bull markets, is they're going to start looking for ways to dramatically increase their reserves so they can sell more gold and silver and make more money. And the only way to do that is to buy little guys, smaller miners, who have found notable deposits. So what will happen in the not too distant future, assuming gold and silver stay where they are or go up from here, if they crash, that's a different story. But if they kind of stay in this range, the big guys will start buying out the little guys in the mining sector, which will lead investors and junior miners to start looking around for who's next. This stock got bought out for a 70% premium to yesterday's price. Well, who else is that going to happen to? And then they start buying up pretty much any junior miner, and you see a brief but exciting kind of .com environment for the junior miners. Anything with gold or silver in their name will be bought by people who are chasing momentum, and so that will add a lot of thrills and chills to the precious metals mining sector going forward. Which now seems like kind of a boring place. Well, it's going to be as exciting in 2 or 3 years as it is boring right now, which means that if you're going to own equities and you've got, say, a lot of bank stocks and tech stocks right now, it makes sense to start cashing those things out and start looking at junior miners where the risk is, if anything, a little less than in bank stocks and tech stocks, but the upside potential is dramatically greater right now. So in other words, there's a shift in asset allocation that's going to go on out there that has not really started yet. But once it gets going, it will find a tremendous amount of money trying to get into a very small sector and sending a lot of those prices through the roof. So good place to be ahead of that,
All right. Well, John Rubino, we really appreciate you giving us an update on all these topics. And before we let you go, if our viewers are interested in hearing more of these interviews, please hit the subscribe button and the bell icon so you'll be notified of all the new interviews we're doing. And where can people find you online, John? And any last thoughts you'd like to add?
Well, I run dollarcollapse.com, which is a gloom and doomy finance site that it covers a lot of this stuff. And it's updated daily. So the idea is go there in the morning or in the evening, and then you'll be pretty much current with what's happening in the dark side of the financial world.
All right, John Rubino, once again, thank you so much for your time, and God bless.
Thanks, Elijah.
Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.